Rob, welcome to the show today.
Yeah, thanks for having me. Super excited to be here.
Yeah, you really scaled a fairly large company, about $750 million in real estate, and it all started with a $50,000 investment. So I want to get into the scaling, super exciting about that, but I'm also very interested in about the beginning. How does someone get into the business and how does someone parlay 50 million, $50,000 into $750 million? So how did you get involved in the real estate? What did you do with that $50,000? What was going on in your life? Like, why did you even get into real estate in the first place?
Yeah, sure. So my journey is interesting in real estate, like many others, but I actually grew up in a real estate family in Northern California. But the funny thing is my parents, they didn't make it look glamorous, and so they struggled with their business. They were agents selling, buying and selling homes for their clients. So they were in the residential space. And we were living in Silicon Valley, and so they were looking at all the families that were very successful in tech. And so they were saying, you want to go to Stanford, you want to go to an Ivy League, and you want to study tech, and you want to do a startup, and you want to make it big. You don't want to do this boring real estate thing. This is hard. It's not nice. And so I said, yeah, that makes sense. So I went to college at Carnegie Mellon for computer science, thinking I would get into consulting or into a startup. But sure enough, the real estate bug hit me while in college because growing up, I had always played football. So I dedicated my life that wasn't doing school, I was doing football. So I was accustomed to spending 20 hours a week on something in addition to school. And so in college, I decided not to play football, and I all of a sudden had this extra 20 hours a week, and my brain instantly turned to money. How do I make money? I want to make money now. And so kind of as a kid, you kind of think about the stock market and you think, okay, well, can I make money in the stock market? And we all know that it's very, very difficult to have an edge in the stock market. And so then my mind went to real estate, which is something that I'd already had a lot of familiarity with given my family. And me specifically, I had the familiarity of single family given my family's background. And single family is a very natural progression into multifamily. It's just one unit versus 100 units. So I could grasp the business very easily. So when I started listening to podcasts like yours and, reading on Bigger Pockets and buying all the books, it was clicking for me. And so the light switch went off and I got super obsessed and wanted to scale a long-term vision. I'm really like a long-term thinker, and that's was the big epiphany between single family and multifamily.
Well, it's interesting because a lot of people can't get out of the single family house investing mindset. I mean, there's people who are like, oh, I'm just going to buy a rental once every year, once every other year. And they do this for like 5 years, right? Or whatever. And they never really wake up and say, wow, that's $200 a month that I'm making here, which is gone once something breaks. Like, I'm never going to actually get to my result. Now, maybe because of your background in single family house, but why did you skip that phase and go like, this is for the birds. I need to do real estate, but at a bigger scale.
Yeah, there's really two reasons. It's firstly seeing my parents struggle. It was even worse for my dad's mindset was forget buying a single family rental. He said, I can't even afford that. If I'm going to buy a single family deal, it's because I'm going to flip it, right? I can't tie up equity. So everything was about a commission, everything was about a short-term gain. And I mean, that's great. You can make a lot of money and you can be successful. But to me, I thought about, okay, how do I institutionalize this? How do I build this into a business, not a high paying job, and really build long-term equity? So it was really the juxtaposition that gave me that nudge right off the bat. And then secondly, in all seriousness, I was, just a kid who didn't know any better. I didn't know how hard everything is in life. I didn't know how hard it is to build a business or how hard it is to raise money. I just looked at the world and I thought, okay, wow, well, multifamily looks good. Let me just skip a few steps and go right to syndicating a 200 unit deal.
Okay, most people will go, okay, cool. How am I gonna get the money from this, right? People they know about apartments, obviously, but they always think it's this advanced strategy that they'll do later once they whatever flip some houses, and once they save up enough money, right? And so most people are like, okay, hold on a second, I don't really have the money for that, right? In your mind, somehow you move past that. How in your mind did you move past the money part?
Well, again, first, honestly, I was very lucky to be so naive because I had no idea how hard it was to raise money. I just thought, well, if I can find a good deal and pitch it, people will invest. It was totally an afterthought. And so I was in for a rude awakening because, as you can imagine, without putting in prior effort, you're not going to get a result. And so the first handful of times we went out to raise money, it was really, really challenging. And it smacked me in the face hard. And it made me realize that it doesn't matter how good of a real estate guy you are, or how much you want to be in the nitty gritty of the real estate business. If you aren't in the marketing and sales business as well, it's nothing's going to happen. So early on, I, hit those challenges, hit those roadblocks, and had to adjust my perspective because honestly, when I first started in real estate, I thought that people who raised money and people who spent their time on sales and marketing were sleazy salespeople. So I had a terrible mindset, honestly.
Okay, so again, you're hitting all of the major objections that people have around raising money. I'm not a salesperson. I don't want to beg people for money. I don't want to manipulate people. And so when you how did you reconcile that in your head when you finally discover what capital raising is? What is it actually like? If not that, then what's it like?
Yeah, well, it is exactly what it is, right? It's a sales and marketing, right? And you have to build relationships and trust. And the thing that is unique, aside from most other sales and marketing type things, is it's such a longer sales cycle. When you're talking to a potential investor or when you're building a connection or you're doing some marketing, you don't know if that's for a closing in the next month or if it's in the next year or if it's in the next 5 years. And and that's okay. You kind of have to get okay with that and just keep putting one foot in front of the other. But the other thing for us when we started out, it was we didn't really have another option, right? Once you put that first deal under contract and you make a commitment and you put money up and you say, I'm going to go raise the money, you've now put your back against the wall, all right, for better or worse, right? And so I think when you do that, you get more out of yourself than you otherwise probably would, right? I made one extra cold call. I did one extra Zoom interview. I did one extra cold email because it was really, I had no other choice. I didn't have the luxury of spending time thinking, well, do I enjoy, investor relations or do I enjoy asset management more? There really was no thinking time. It was just go time.
Okay, so how did you actually then overcome this? You thought it'd be relatively easy to raise money once you found a deal. It looks like you got punched in the mouth a couple times. You're like, oh, it's maybe not so easy. So how did you actually then succeed? What did you do to overcome this problem?
I think the cheat codes, if you will, which I don't really like saying that because it's not like there's, easy ways to go, but everything is hard, right? But I think one of the best things to do is seek partners, right? It sounds so simple, it's such a no-brainer, but a lot of people don't even think about it. They don't think that that's possible, or they don't think that it pays, right? Oh, well, if I bring a partner, there's going to be nothing left for me, and that's obviously not true. You can build really strong partnerships that allow you to grow the pie, and you might be getting a smaller slice of it, but it's a bigger pie. So for me, getting those first few deals done really required humility and going to people and saying, you know what, I'm struggling to raise the money. I need your help to get your backing, to get your support, for you to reach out to your network, and I'm willing to do whatever it takes. And I don't need to get rich off this deal, right? I just want to get the deal done and I want to build my experience and my relationships.
So you basically got started a little bit more like a deal finder, and you found that you had to partner with more capital raisers, or these people that you're partnered with. Are they more, were they experienced operators? Like, were they already in the space and you kind of just brought a deal to them, or how did you engage with them?
Yeah, it's similar like that. I think it is easier if you're getting started, it is easier to go to people who are in the space because you're not teaching them anything they don't already know, right? So you're not teaching them a new language. Whereas oftentimes when we're speaking with a newer investor who maybe is, in a high paying job in Silicon Valley, we have to teach them the language of real estate. We have to explain to them kind of the terms of the deal and the dynamics and the fees and things like that, right? But when you bring it to somebody who's in the industry, they can see it's a good deal, they can speak your language, and they've got the built-in network, they know what to do. So I think that is very helpful when you're getting started, but obviously it's less profitable because they're going to take a bigger chunk of the deal. But like I said, when you're getting started, it takes humility to understand that you're really only bringing this piece of the puzzle to the table, even if you are the lead GP, so to say, right? because you're going to need a loan guarantor. You're going to need help with property management. You're going to need help with raising capital, with asset management, and so on.
So the thing that never occurred to me when I'm like, because I flipped 3 dozen houses, right, is this whole idea when you get into the syndication world, it's all about joint venturing and partnering. And you just talked about it here. Now, I don't know if you knew that going in. It sounds like you probably did, and you're like, oh my gosh, how did you figure this out? Like, how did you figure out, my gosh, I got to start bringing in partners. I need a KP. I need someone to do this. I'll maybe find a deal, but I need someone to actually really raise the capital. Like, how did you figure that out? Because a lot of people kind of go, oh gosh, can't be done, right? I thought I could do it, I can't do it. And you're like, no, here's a solution. How did you come to that conclusion?
It was really, I mean, honestly, this is not a recommendation, right? I don't think people should do the same thing because the way that I got through it was just basically putting one foot in front of the other and putting the deal under contract. Okay, well now what's next? Oh, turns out I need to do due diligence.
Oh
Okay,
dear.
what's next? Oh, well, turns out I need a loan guarantor. What's next, right? So I don't think that's the most expedient way to learn or the most efficient way to learn, but it also is a great way to avoid and completely eliminate paralysis by analysis.
Yeah, just putting one foot in front of the other. So you started off kind of with a maybe a minority stake in some of these deals that assume that you found, right? That's how kind of how it started.
Yes.
And then how did that evolve? So you have this relative minority stake when you thought you're going to be this, the majority, and then all of a sudden you're giving up to somebody else who's more experienced, has the experience, and raises the capital. You said requires some humility. So how did the deals evolve from after that?
Yeah, and then, through these experiences, you start to understand, okay, well, these are the pieces of the puzzle. Because first you need to know what those pieces are. Then you need to actually put those pieces together. And then slowly but surely, y- me or whoever is listening to this, if they're looking to go down this path, you start becoming more of those pieces of the puzzle, or you actually start growing as a company and bringing more people under your umbrella. And so and that's still what's happening now. We're still evolving as a company today, even though we're, much bigger than we are. There's still things that we are bringing in house now, such as taxes, accounting, and construction and things like that. So there's always more things to integrate and ways to vertically integrate. But you want to go one step at a time. So for us, what that looked like was basically, okay, well, maybe the first deal we only raised, I don't know, let's say $1 million of our kind of direct investor capital. But in the next deal, let's try to beat that. Let's try to raise more capital from our investor network and then continue to grow it so that way we're fulfilling more of that requirement ourselves, right? And then with scale and time, we're able to hire more people. So now we have property management in house. So we're able to have regional managers and corporate people on the operations side and things like that. And now we don't have to bring somebody on the team who has the asset management experience, right? Or we don't need a loan guarantor because the lender now trusts us to fulfill those responsibilities. So I think rather than it is very overwhelming, right? People think buying real estate is simple. It's like, oh, you just buy the deal and then it manages itself and it cash flows and that's that, right? Couldn't be further from the truth. Especially in multifamily, the property management business is so intensive from a time, capital, and human capital perspective. If you take your eye off the ball 1 month, your occupancies are going to dip and your expenses are going to get out of whack. So in this business, there's really you can't assume that you can just build Rome in a day, right? And so I think that was a natural growth progression for us.
Yeah, so you got into this kind of like I call it as a deal finder. It's very, very common. And you raised some money, but you needed a partner to kind of bring in the KP or the experience and the additional capital. And then things evolved as you figured out what the pieces were, and then also your capacity to raise capital also increased as well. So you had less need for these large partners, and you were now the majority GP. And I think that's how it goes. A lot of people have that progression, whether they come from the deal finding side or even if they come from the capital raising side, right? Because the capital raising side, they don't have any deal flow. So they actually oftentimes partner. And they do this for a few times. And like, how do I get more of the GP? Oh, maybe I should actually hire someone and get into the deal findings side, so I don't have to partner with someone like that. And that's typically how it evolves. Now, a lot of syndicators who do their first deal, okay, that's super awesome. It's a major thumbs up. And then when you ask them what their plans are for the future, they're like, well, I'm just going to do another deal slightly bigger than the previous one. And there's really not this idea of building a business or scaling. And at what point did you want to scale a business? Was it all the way from the beginning? Was it after a few deals? Or at one point did you say, oh my gosh, I actually have to sit down and think about this more as a business and a really large business where I need processes, I need to start hiring people. When did that happen?
The desire was from the outset. So, there was definitely the ambition and the vision there, but you can't be everything, right? You can't be the gas and the brake, generally speaking, right? And so you can't the visionary also needs to be supported by the controller, right? By someone who has the organizational skills and who has the capacity to really implement what you mentioned, which is the SOPs and the controls, right? Building out the processes and things like that. So I really had no idea kind of the step by step as far as how to build all that out. And fortunately, I've been lucky enough to surround myself with a fantastic team who have the property management experience and the asset management experience and the finance side of things. So we've been able to put those processes together. But yeah, it wasn't, I had the vision, but I didn't have the clarity of vision at the beginning.
One thing that I keep noticing is that you're a bit like me. You keep trying to figure stuff out on your own, right? And I've done this for years, and it's so tedious. Like it takes so long. I was curious to see what would you have done differently going back to the beginning when you got into the business, and you're like, I didn't even know I didn't know. Like obviously you learn so much, and I learned so much through all my mistakes. But now in hindsight, uh, mistakes are good because you learn from them, but the avoidable ones, why don't I avoid some of those avoidable mistakes? And I'm just curious to see what you would have done differently if you had could speak to your younger self.
Sure. Yeah, I think there's some stuff that, and always hindsight is 2020, right? So it's so much easier looking back. But when you're getting started in anything that you're passionate about, there's this, strong desire for action, and I just want to get started now. I just want results now. And especially when you're younger, and I think it's really valuable to have a bit more patience and really double check things and get reference checks. And if you're thinking about partnering with somebody or you're thinking about borrowing money from a certain lender or partnering with a certain management company, it helps to just, spend a little more time doing due diligence. So trust but verify, be a little patient. You don't have to buy the first deal you see. So I think those sorts of things really help balance out the excitement and ambition. So that's kind of number one. On a more practical level, I would say, and this is honestly true of almost every single person who gets into real estate. You you buy in a neighborhood that you later regret buying in. And it's because when you first get into real estate, you've heard it a million times. You've heard how important location is, right? We all know location, location, location is the number one rule of real estate, but you don't really know the challenges of owning in a tougher area until you live through it. And so I think it'd be nice to just fast forward through that, right? It'd be nice if you could have skipped over those 3,000 flips and just go right to the big stuff. But same thing, everyone who gets in multifamily, they generally start by buying a Class C asset. Why? Because it's a little bit cheaper and the returns look a little bit better on the spreadsheet, but you're signing up for a whole ton more work. The tenants trash the property more. There's more move outs every single month. There's more delinquency. There's more crime. So there's just a ton more to deal with. It's a good way to learn, but it's very, very challenging. And often the risk is not worth the reward from an investment perspective. Similarly, debt. Debt is also another way where the more you use, the more attractive the numbers look on the spreadsheet. But in practice, in principle, debt, as we all know, cuts both ways. And so I think that some of the most fantastic outcomes are achieved with high leverage, right? You hear the stories. You hear, oh, wow, this person, they put 100 grand into this deal and it's 300 grand in 2 years. That's incredible. Well, the way they did that was frankly by taking a ton of risk and it worked out, which is great. But it's really not fun when you take a lot of risk and it doesn't work out. And that's where using actually less debt comes into play. The challenge is I could share this concept till I'm blue in the face, but people who get started, including myself, are very rarely going to take the advice because it's so difficult to do so. Because if you take less debt on a project, where's the difference coming from? It's coming from equity. Now that's more equity you have to raise. We all know that when you're getting started, raising money is already the hardest thing. So it's really, there's no easy answer here, but I would say those lessons would be just incredible to take to the past. Patience, less leverage, and prioritizing location.
Yeah. A lot of lessons learned there. Now you talked about you always wanted to scale, you had the vision, but you didn't really have necessarily the team early on. I think it's a challenge when you first get started, right? Because the only thing you have to have you really have in the beginning is equity. You can throw equity around by bringing on partners. You don't really have necessarily the income to afford to hire people. How did you overcome that? So when you first got started, how were you able to afford bringing on those first, well, first of all, who did you bring on first? Like what was your order? Did you partner your way there? So a combination of partnering and hiring. How did that growth happen in the early days when income was limited?
Yeah, very good point. So, starting out, I had a business partner. So, you talked about you can throw around equity, right? So, starting out, I had a business partner who I was able to partner with, obviously by sharing in the equity and the risk. And from there, a couple years later, our first hire was an acquisitions analyst. I think that's a very typical first hire because it's one of the first parts of the business that becomes essentially time consuming and repetitive. And I wouldn't say it's low value. It's definitely high skill, high value. But if you're trying to lead and grow the company, you shouldn't be spending your time in the spreadsheets all day. So that was our first hire, and that allowed me to free myself up so I could spend more time on growing the business rather than, sourcing deals and crunching the numbers.
And how did you and your partner split up your roles?
So my roles initially were focused on acquisitions, which then bringing in the acquisitions analyst, of course, obviously helps me in that department, and then also for me, marketing and investor relations. So I was basically kind of like between brokers and investors, the face of the company, and then also, of course, kind of guiding the acquisition strategy. And then my business partner was overseeing operations, which include, at that time, when you're starting out, you don't have a big portfolio, so there's not a ton to operate, but there's still a lot of things going on between transaction, transaction coordination, legal, accounting, property management, asset management, and at that time, investor relations or the investor reporting was kind of more so sitting in the asset management side of the house. Today we have obviously a much bigger team, so we have three asset managers with an asset management analyst, and that team puts together the monthly reports for investors, and then those reports go to the investor relations team, and then we have three, four people there who review those and kind of clean them up and make sure that they get delivered to investors properly.
That's interesting, right? So how do you nurture a relationship with your with investors, right? So investors come in through a variety of different ways. You go to events, you're speaking, you got some lead magnet, they're coming in, they're, whatever, they're filling out a form or whatever. How do you guys, what is your process for, nurturing those relationships to the point where they eventually invest? Because they'll come off a Facebook ad, they look at you, it's cool, here's 100 grand. At least that used to happen that way, right? It happens a little less right now. But then others, they'll stay on your list and they'll watch and eventually they either go away or they invest. But what do you guys do to nurture those relationships?
Yes, you threw out a lot of really powerful stuff, and I think when you're getting started on the marketing side, that could sound very intimidating. If I told you, hey, in order to raise capital from investors, you need to have a YouTube channel, you need to have a podcast, you need to do a newsletter, and you need to be on Facebook and LinkedIn. It's like, whoa, this is insane, right? So my thought and my recommendation is if someone's looking to get started on the marketing side of things, it's basically just pick one thing and do it well. And that could be a written newsletter, it could be a video series on YouTube, or it could be, an audio only podcast. Whatever it is, you just want to focus on that and make it good because whatever you do is not going to be good at first, right? But you focus on it, you make it good, and then you can repurpose it and syndicate it out to other things, right? If you're making content dedicated for LinkedIn, that content will probably do just fine on Instagram as well when you're getting started. So for me, it was a similar path of kind of my first interest was writing. I like to kind of think and write and get my thoughts out on paper. And so I started sending out a monthly newsletter. That monthly newsletter became somewhat popular, I would say, and that helped attract more investors. And then kind of adding on, okay, let's do some YouTube videos, let's do some podcasting, and so on and so forth. And then you mentioned a big piece, which is a lead magnet. That is a game changer. Having a lead magnet where you're actually enticing people to want to give you their email, have a phone call with you, join your ecosystem. All that is, you know, basically table stakes, right? From there, that's where things get interesting because you might have an amazing phone call with a potential investor, but it might just stop there. And so we're very intentional about making sure that we put a lot of effort and time and money into a potential investor lead. So I don't want to just have a good phone call one time and leave it at that, right? I want to make sure that we're following up. I want to make sure that we are really figuring out what their needs are. Maybe they're interested in 1031 exchange. Maybe they're interested in a short-term investment, which is really not what we offer. So we kind of, you know, push that in a different direction. Or maybe they're interested, maybe they're super interested in what we do. So we make sure that, hey, we'll call you next week. We'll call you the week after, and we'll stay in front of you. To your point, it's been a very difficult time in the market over the last few years. And when it comes, so for example, we were quite busy in 2024. We closed 5 deals. And so when you're closing deals back to back, it's a really great way to stay in front of investors because you
Huh.
have something to talk to them about, right?
Right. Right.
Right now we haven't closed a deal all year, so it's been 6 months. So it requires an extra level of effort and I would say creativity to stay in front of investors and provide value. Because if we're not pitching them a deal, it's like, hey, let's go out to dinner. We're gonna host an event where we talk to you about this strategy. Or, my sister Dasha, our director of investor relations, she just published a book about 1031 exchanges for syndications. Very cool topic. So, our office assistant right now is busy writing handwritten notes and shipping out this book to a bunch of our contacts. So it's just finding creative ways to stay top of mind.
Yeah, that's very, very interesting. Have you considered, so it's interesting, right? Because deal flow has been a bit of an issue. Have you considered, or have you maybe raised money for other operators at all to keep your investors engaged, or have you kind of stayed away from that?
We've stayed away from it. I think that's tempting. We've got people on
It
the
is
team who
tempting.
say, hey, let's raise a debt fund or let's do this or let's do
Hmm.
that. And I think my that could work and that could be smart, but I always go back to my long-term vision. I think, okay, 30 years from now, what do I want to be remembered for? What do I want our business to be known for? And I really want our business to be known as that old, boring business that does the same thing over and over again, and they do it really well. They don't get ahead of themselves and you know, kind of get over their skis. So that's I just bring it back to the long-term vision. So it might suck now to, not really have much going on the investor raising capital side of things, but long term it's going to be totally fine.
Yeah, that's right. What's kind of been your biggest challenge over the last few years from running a syndication operation?
Well, far and away, the last few years have exposed the challenges of operations
Hmm.
because and you can bring up the Warren Buffettisms of, when the tide goes out, you can see who's swimming naked, or uh, basically an up market makes everyone look like a genius and your sins are washed away. But when the market is flat, not even necessarily down, which it has been, but even if the market's only flat, now it really exposes, are you a good operator? Are you the one creating value or is it just the market? And so when we've been in a down market for the last few years, you are swimming upstream. And so your operations have to be that much better just to tread water. So it's been a huge investment in our company to really redefine what it means to be a good manager of apartments. And so that included actually a stint last year where I moved down to Houston and I lived at one of our properties so I could immerse myself in operations, really meet all the people, understand how everything was working. And we've really made amazing strides just by putting in the effort and, not seeing the market just go up and up. So I think it's really a blessing in disguise because we're building such an amazing foundation for when the market does reset and valuations and rents and everything are going up and up again, we're going to be that much better equipped to take advantage of the opportunity.
I think it is a blessing in disguise. It is nevertheless painful. It's just we have the same thing. I mean, operations have been a real challenge, and and we have made a lot of changes and pivots in response to it. And it's a slow moving slog. It's like it's so slow moving, right? But we're constantly getting better, slowly getting better, and it has exposed a lot of shortcomings that weren't there before in a market that's going up. So it is a blessing in disguise. On the other hand, because of it, I think we have been slower to grow because we've had so much operational stuff to focus on that has really prevented us from really growing more aggressively. But it is kind of a blessing in disguise because if the wheels are half off and you just kind of throw, fuel on the flames, the whole thing's just going to explode. And so it is probably back to your point, sometimes better to go a little slower and build a stronger foundation before you can move forward. What are you excited about moving forward?
Well, I'm just really excited about every day. To your point, operations is a slow burn, right? It's very different than the investor relations business and the acquisitions business. In the acquisitions business, you get a deal awarded, you put it under contract, you close it. These are champagne moments. These are big wins. And similarly, on the investor side, if meet a new investor and they want to invest $1 million with you or $5 million with you, it's like, wow, that's amazing. That's a huge win. Operations is a very different game. It's every day a win, every day a loss, and you just keep working at it. So I'm just excited to uh, just keep on the path that we're on. I'm very confident that if we just continue to put one foot in front of the other, we don't have to reinvent the wheel. We just keep doing what we're doing. We're going to see amazing results. And I think, like everyone else in our business, we're looking forward to the days of interest rates and the market and sellers making a little more sense so we can just kind of get to business. We're not looking for 0% rates necessarily, and we're not looking for, the market to get overheated like it had been, but just a nice stable market where we can continue to grow. I'm just super looking forward to that.
Yeah, and are we going to get a stable market, or what's in your looking glass there for that?
Yeah, my crystal ball is really, as usual, broken. So I think everyone's crystal ball is broken right now. It's really tough to say with the uncertainties associated with tariffs, interest rate policy. The bond market is saying one thing, Fed saying another thing, and so on. So I've been kind of holding strong to the belief that the economy is weakening, and it has been for the last few years. And when I say weakening, I'm not being super negative. I don't think, oh, big recession, depression, that sort of thing. But one of the positives associated with weakening is a reduction in inflation. And if you look at kind of the most recent numbers, inflation has really calmed down substantially to the point where I think that, and of course, this is self-serving as a real estate guy. I think the Fed is totally behind the eight ball when it comes to lowering rates. I think th inflation is not the main challenge of the economy, and I think rates are substantially restrictive at the moment. However, Jay Powell has a very difficult job, and I think at the same time, they're looking at the one-time shocks potentially associated with tariffs, and they're just looking at the job market. Labor market is, resilient, as they like to say. It is until it isn't. And so I think what's going to happen is basically the Fed's going to hang on to rates where they are as long as they can until the economy looks it breaks or it looks like it's breaking, and then they're going to cut fast. And that's just kind of how history goes. It's like everything's fine, and then bang, rates start coming down fast. So I think we're going to see that happen over the next probably 12 months.
Rob, how can people connect with you?
To learn more about myself and our company, Lone Star Capital, you can head to our website, lscre.com. On our website, we've got awesome resources, free download of our underwriting model, link to the books that we've published, and ways to get in touch.
It's been awesome jamming with you here today, talking about scaling in real estate, my favorite topic. So, Rob, thanks for being on the show today.
Yeah, thanks a lot for having me.